Not even Nvidia can outmatch President Trump. Bloodbath at Dalal Street despite positive GDP data. And what to really make of Starbucks under Niccol's leadership. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. Now, listen, I believe in lucky accidents. I'm a huge believer of lucky accidents, especially when they're on the positive side. And that's exactly what has happened in recent weeks. I mean, I know I've had to post episodes on Tuesday, one reason after the other. Either I was sick or I'm still not well, by the way. Weather is all over the place. You can see it's bright and sunny here in London right now. But in the evening, it goes back to 5 degrees, 4 degrees. So from 14 to 4, 14 to -1, it's just been crazy, right? So my throat's all over the place. But I've had to, like I said, I've had to post episodes on Tuesday, sort of the usual Sunday time slots. But turns out you guys like the Tuesday show. I mean, they like the fact that the show is being posted on Tuesday compared to Sunday. I mean, so I was like, why not give you guys exactly what you want? And this is why. Okay, I'm not fully fit, but I thought I'll record it on Tuesday and publish on Tuesday. And of course, if it was a one-off and you guys prefer the Sunday show, then I'll revert back to Sunday evenings as usual. But you guys run the show, you know this. So I'm more than happy to adjust the show timings based on what you guys want. So like I said, lucky accident, completely not. I mean, I didn't time it at all. It turns out you guys prefer that the show comes out on Tuesday. So for now, we'll do Tuesday shows. And if it doesn't work out, we revert back to Sunday, 7 p.m. Right. Lots to talk about. Where should we start? If I have to characterize, let me start by saying if I have to characterize the week that we just witnessed the week gone by, that we just witnessed, then I would call it as a simple, simply I would put it as Nvidia versus the tariffs week. It was all about that. There was some inflation data, nobody cared. There was some other data, nobody cared. It was simply Nvidia versus tariffs. And depending on what we just witnessed, especially yesterday, the aftermath of last week spilled over on yesterday. The tariff fears absolutely blew Nvidia's scintillating performance out of the water. It was a no contest. Investors decided to prioritize the tariff worries over what has been a record ride. What was a record performance from Nvidia. More on that in a bit. Just want to first summarize the market performance last week. Once the dust had settled, the bearish sentiment continued in S&P 500, which is down 1%. The tech-heavy Nasdaq tumbled 3.5%. We also had a little bit of a drama in the White House between the Ukraine president and President Trump. Not going to go into the details. It's not a political show, but the clips are, you must have already seen the clips. I'm going to let you guys decide what turned down. I'm here to talk about the markets and markets alone and the implications. But I just want to say whatever transpired in the Oval Office also had a little bit of negative impact on the markets because it happened, as the market headed towards close on Friday. So S&P 500 down 1%, tech-heavy Nasdaq tumbled 3.5%. The Dow actually bucked the trend, gaining 1%, although yesterday, which is Monday, once we got confirmation that the tariffs will go ahead as promised, the index tumbled more than 600 points and the Nasdaq was down 3%. It was a bloodbath on Wall Street as well. So, lots to get through. As such, let me quickly welcome you to the Doctor's Weekly Snapshot and take you through all the major developments that took place in the US markets last week. One that I characterize as Nvidia versus tariffs. Let's start with the Super Bowl of Q4 earnings, Nvidia. Right. The company reported very impressive financial results for the latest quarter, in my opinion, demonstrating the continued strength of the AI boom. The company's performance exceeded expectations with significant growth in both sales and profits. I'll give you, I'll be doing a little Doctor Dissects on Nvidia in the coming weeks, where I will take Nvidia under the microscope and do a deep dive analysis. But for now, just like what I did with Walmart in the last episode, let me give you a little tease on what to expect. Q4 revenues came in at 39.3 billion, up 78% year over year. Net income came in at 2.2 billion just for the quarter, up 80% year over year. Data center revenues came in at $35.6 billion, up a whopping 93% year over year. Projected sales for the next quarter. Remember, Nvidia gives you guidance quarter by quarter. Projected sales for Q1 of next fiscal year, were 43 billion, surpassing analyst expectations as well. Nvidia's new Blackwell AI chips, the one that everybody has been talking about, the one where doubts had been raised thanks to the DeepSeek saga, actually did phenomenally well as well, generating $11 billion in revenue. accounting for nearly one-third of the data center segment's revenues. Blackwell also became the fastest product rollout in the company's history. CEO Jensen Huang, surprisingly, in a very towards the end of the earnings call, in a completely unsolicited manner, actually supported DeepSeek, claiming that there is a noticeable shift towards reasoning models in AI, which should continue to be a tailwind to Nvidia sales, especially for Blackwell, as these models are estimated to need 100 times more the computing resources. In other words, there was absolutely no visible fallout from the DeepSeek saga. Now, you would think this would be enough, right? You would think this would be more than enough for the stock price to go boom upwards, right? Nope. Expectations were so lofty that investors just demonstrated post the Nvidia's results how picky they were. Q4 was absolutely no different. And Nvidia investors have really been picky with Nvidia in the coming quarters. Q4 in the past quarters, Q4 was no different. The news that here's where I get frustrated. The news that gross margins are expected to slow down, yeah, in the first quarter still coming. By the way, the slowdown implies a 71%. Yeah, gross margins expected to be 71%, which is actually an insane number for the chip company. But you tell that to these pessimistic investors. A point clearly highlighted by Nvidia management in the last quarter. Nvidia management did say Blackwell ramp up will affect gross margins in the first half of the year before going up to finish around 75% by the end of the fiscal year. So the fact that market already knew this and yet was disappointed, to me, is just ludicrous. Right? It was more than enough to drive shares down. And on Monday, which is yesterday, thanks to the tariff confirmation, thanks to the tariff fears, the additional 10% tariff on China that President Trump is planning to impose, which goes 20, by the way, all these tariffs go live today. It might have actually gone live today as I'm recording this. But on Monday, thanks to the tariff fears, the stock, get this, finished nearly 9% lower, knocking another $265 billion off the company's valuation. This is where I have to say, investors, according to these investors, fundamentals be damned. I don't get it. I don't get it. I don't understand. If the information was already there, and yet there was a bloodbath in the name. I mean, this is a name now. It's trading around last September. September's price, last time I checked, it was trading at around $113. It's absolutely insane. Now, speaking of tariffs, and this is where I tell you the tariffs fears blew Nvidia's or rather overshadowed Nvidia's strong results completely. It was like absolutely there was no match, right? Normally it was Nvidia was versus the Fed, and Fed is no match, but this tariff fears completely overshadowed Nvidia. Now this obviously brings me to the fact that not even Nvidia can withstand the Trump effect. More specifically, the fears stemming from the potential tariffs that President Trump has imposed on Canada, Mexico, and China, which are expected to go into effect today. Like I said, as we speak, this would be, as I record the show, this could very well be, it could have very well have gone into effect. President Trump confirmed this last week as well, that the previously delayed 25% tariff on imports from Canada and Mexico would indeed go into effect on March 4th, which is obviously today, along with the additional 10% on imports from China. He had already imposed 10%. Now we're thinking about another 10%. Remember, he said 60% during election campaign. Like I said, guys, the weather is absolutely confusing me. I'm now sweating, and in the evening, I will be freezing. Madness. So it's 10%. He had already imposed last month. Another 10% goes into play. So 20% on total on imports from China. Now, this additional 10% increase would raise the total tariff revenue to approximately $86 billion, surpassing the $77 billion collected from all sources in 2024. So clearly, tariff revenue is what President Trump was looking for. And apparently, he basically confirmed it on yesterday, that is, saying that there is absolutely no room left for talks and the tariffs are absolutely going in. Like I said, President Trump had hinted on this last week. He cited insufficient progress in curbing drug smuggling as the reason for moving forward with these tariffs. While Mexican President Claudia Sheinbaum expressed optimism about reaching an agreement, well, clearly that optimism was very short-lived. Both Canada and China are likely to respond with retaliatory tariffs. In fact, Canadian Prime Minister Justin Trudeau already confirmed this last week. China, they don't speak much. They just go ahead and do it. So you would expect retaliatory tariffs from them as well. I would be shocked if they didn't. As a result of the confirmation yesterday that we got about tariff fears, all three indices fell off a cliff. Like I said, Dow more than 600 points, S&P 500 nearly more than 1.5%, Nasdaq nearly 2.7%, was a bloodbath on Wall Street. And the National Economic Council also raised concerns about the potential inflation resulting from these tariffs. To make matters worse, there is now an actual fear of stagflation. Remember, slowing growth and high inflation, that's your stagflation metric, creeping into investors. While last week's PCE's index, the Fed's preferred inflation gauge, yes, guys, amidst Nvidia versus tariffs, there was an inflation metric as well. Nobody really cared about that. Like I said, it was the battle between the two powerhouses, Nvidia and then President Trump's tariff effect. While last week's PCE index, the Fed's preferred inflation gauge, came in line as expected, remember the CPI came in much hotter than expected in Feb. At the same time, yesterday, we got the latest data regarding the US manufacturing sector, which unfortunately has started to show signs of cooling based on at least the February data. More specifically, according to the latest report from the Institute for Supply Management, the ISM index, the ISM manufacturing index fell to 50.3% in Feb, down 0.6% from Jan, and below the market consensus estimate of 50.7%. While a figure above 50 suggests expansion, the fact that it is right at the borderline also worried investors. Remember, 50.3, you're really close to that expansion contraction. 50 is expansion. 50 and above is expansion. Anything below 50 is contraction. So you're right at the borderline. And that clearly worried investors as it shows an environment where growth appears to slow down. Add to this, the consumer confidence plummeted 6.7% in Feb, the largest drop since, get this, 2021, despite other positive economic indicators. And you really have to wonder whether 2025 is the year when markets turn for the worst, take a turn for the worst. Listen. We're expecting double-digit, 24%, 25% more plus returns on a hat trick of years, but you've got to wonder whether this is the year where they simply break based on all these negative vibes and negative sentiment that is flying around. Look, as far as I'm concerned, despite yesterday's negative data and President Trump's tariffs going into effect, I still think the market reaction has been overly negative, especially when it comes to Nvidia. I understand that stocks relied on momentum, and I want you to think about the likes of Palantir and Robinhood have absolutely gotten crushed, probably deserve the correction given the fact that they went up so much with the fundamental. When Palantir at one point was trading at 100 times next year's sales, and that's just crazy to me. I just don't. So while I do think that those particular stocks whose fundamentals never made any sense, deserve to get a little bit of deserve to go through a little bit of correction territory, I just don't understand the negative sentiment surrounding Nvidia. It appears to be a classic case of irrational fear, appears to be a classic case of shoot first, ask questions later, all of that. You can think about all these, sayings. Nvidia's quarter to me was absolutely phenomenal. And I'm a little surprised that after the excessive selling seen post DeepSeek, investors still decided to keep selling the name despite a blowout quarter. Nvidia's top 5 customers continue to spend, and Blackwell's numbers have been phenomenal despite the initial hiccups. What is ironic is that DeepSeek might actually turn out to be a blessing for Nvidia rather than a curse, as the shift towards reasoning models or shift towards developing reasoning models is only likely to further drive demand for Blackwell. Of course, one can argue that Nvidia's customers are also building their own chips, but in no way, shape, or form did that have any negative impact on Nvidia's performance, and no way, shape, or form did it suggest that Nvidia's performance is going to be negatively impacted in the coming quarters. The company continues to be the chip sector's big dog. The problem is, unlike in the past, it has come face to face with a bigger dog in terms of President Trump's and his tariff plans. Turns out that was a step too far for Godfather Jensen. On that note, let's head to the next segment. The doctor goes home, where it's going to be more negative news for you guys. I think I left my water there. Never mind. Doctor goes home segment. I've got this. I'm very sorry to say already. Spoiler alert. It's going to be a lot of negative news. Right. Normally, a new month would mean that I take you through the Indian auto sales numbers, right? But that, unfortunately, has to wait until next week. I have the numbers ready, but I will talk to you about them next week, since I want to take some time and talk to you about the bloodbath that we witnessed in the Indian equity markets last week. In the last episode, at least last Tuesday, I seem to like it. Thank you for all the love. I discussed with you that, in my opinion, the worst was over for the Indian economy based on some crucial economic reports that we received and some other crucial economic data we received. However, I did tell you that things were not going to look great in the short term. Remember, I told you to put champagne on ice. I wouldn't take this pop up on the champagne bottle yet. Given the twin fears of the potential negative impact from President Trump's tariffs, which have now gone into effect, and the relentless selling by foreign institutional investors. Well, while I expected things to be bad, things certainly became much worse last week, with Nifty setting some unwanted records. Before I get into what investors like you and I, long-term investors like you and I, need to make of the current bloodbath, let me take you through what transpired last week in some detail. Predominantly, it was a massively selling week, with the market saved the worst for the final trading session of the week and of the month, as the Sensex dropped a whopping 929 points and the Nifty declined 1.2%. More specifically, the total market cap of BSE listed companies decreased by a whopping 5.8 lakh crores, bringing it down to 387.3 lakh crores. IT and auto sectors were the most hit, with these stocks, with stocks in these sectors falling anywhere between 2 and 4%. I have a significant portion of my portfolio in auto space, so clearly I could feel the impact. I could feel the impact so much so that now I'm looking to where to load up on the positions. More on that later. Other sectors such as metal, pharma, and consumer durables saw declines in the range of 1 to 2%. Now, the key factors behind Friday's bloodbath were actually the usual suspects, which included the influence of overnight losses in the US stock market, particularly in the tech sector, ongoing worries about slowing economic growth, weakening earnings momentum, and the impact of trade policies, and of course, the persistent selling by foreign investors. In fact, Friday saw FII's record their highest single day selling in February, selling shares worth a whopping 11,639 crores, while domestic institutional investors attempted to counterbalance the sell-off by purchasing equities to the tune of 12,038 crores. It was simply not enough to stem the market decline. The bloodbath on Friday also contributed to the Indian stock experiencing its worst run in 29 years. Nifty, as of the end of February, has fallen about 15% from its September 2024 peak, with 5 more percent, and it's very much in correction territory, with the bear market territory, with the decline erasing nearly $1 trillion $1 trillion worth of investor wealth. In addition to persistent foreign outflows and the US tariff uncertainty, the relatively weak Q3 earnings also helped the stock markets set this unwanted record. There was also more confirmation about things that things are going to look murky in the short term, with Indian markets expected to remain a sell-on-rice market for the foreseeable future, at least according to some of the portfolio managers whose interviews I managed to read for this particular segment. For instance, high net worth individuals and retail investors have reduced long positions. Open interest has also declined across both Nifty 50 and the broader market, indicating weak trader conviction. Local institutional investors remain net buyers, but inflows are slowing, which further shows a lack of conviction among the institutional buyers. That's a lot of negative news. Yeah, a lot of negative news. You almost think that I would have joined in the panic and relinquished my status of being a perma bull when it comes to the Indian markets. Absolutely not. On the contrary, I'm doing no such things. In the coming days and weeks, I plan to load up on some of my absolutely battered positions. Remember, I have a significant proportion of my portfolios in the auto space. I'm definitely going through them, like I said before, to see where, when to add value, looking at a little bit of technical indicators and seeing when to get back in and when to load up. I had some dry powder anyway on the side. I've been waiting for a correction like this, and boy, oh boy, are we getting one right now. And here's why I'm in no way, shape, or form panicking. First, thanks to this crash, Nifty's forward PE ratio has dropped below 20, level seen only twice in the past 5 years. To give you some context, at its peak, the multiple stood at 24.4. In other words, suddenly the Indian markets have become a lot more attractive. Some of the heavily beaten down names are actually high quality names. This makes it an attractive entry opportunity that long-term investors have been waiting for a very long time. Second, I do expect a lot more panic and fear in the markets to come in the short term. This is because investors who started investing only in the post-pandemic era are experiencing their first significant market correction. As such, this is absolutely uncharted territory for them. Some of you might be listening to the show, which could lead to the temptation of selling more. When there is excessive fear and panic, if one is a long-term investor, just like how I am, then it presents a wonderful opportunity to buy. In fact, what we are currently witnessing in the Indian equity markets is actually normal given the cyclical nature of stock markets. It's been a long time coming, this correction. Yes, it came with a bang and caused so much bloodbath. But this correction, there is no way, you can't argue that it was not meant to be. Of course, this is very normal for cyclical because of the cyclical nature of stock markets. Indian equity markets have remained very expensive and have been going up, up and away for a while now. So it is absolutely only natural for a correction to happen. And the fact that this is only the third time that we are seeing price to earnings ratio fall below 20 suggests that the markets were certainly rich in the build up to this correction. What is worrying is that instead of not getting swayed by the market pessimism, investors are actually starting to stop their systematic investment plans, the SIPs, which I have to agree with Zerodha CEO Nitin Kamath. It's a mistake. I mean, he says this is a mistake, and I totally agree. You're not supposed to get swayed by pessimism. You're supposed to continue to invest as the long-term picture remains strong. And here's why. Finally, so I gave you two reasons as to why I'm not panicking. Third reason, the macro setup continues to look promising for the Indian economy. One of the reasons of Friday's bloodbath in the markets were investors' nervousness related to the GDP data. Turns out all those jitters were for nothing as Q3 GDP came in very, very strong. Increased government spending and rural demand saw Q3 GDP growth coming in 6.2%. And while this was lower than the whopping 8.6% recorded in the year ago period, the fact that it rebounded from 5.6% in Q2, which was the slowest pace in 7 quarters, is promising. Furthermore, the expectation is that the GDP growth will now start picking up due to low base effect, low cost of capital stimulating investment demand, and consumption support from the income tax cuts. Not to mention, like I said last week, Budget 2025 saw tax cuts announced to the tune of 1 lakh crore, and the RBI has reduced interest rates for the first time in 5 years. Even the IMF expects India to remain the fastest growing major economy with real GDP growth, and that's basically after accounting for inflation, expected to remain at 6.5% for both FY25 and FY26. The IMF cites broadly declining inflation, non-performing loans at multi-year lows, and continued fiscal consolidation as some of the key factors that would ensure that the Indian economy grows at these healthy levels. Moreover, in addition to lowering rates, the RBI has also lowered the capital buffer requirements for banks lending to NBFCs, with risk weights on loans to microfinance lenders and borrowers immediately restored to previous levels. So it was 125% weights. Now they've gone back to the original 100%. This reduction from 125% to 100% could free up to 40,000 crores worth of capital for banks to lend, which could potentially enable banks to lend up to 4 lakh crores to AAA rated companies. This comes at the right time as bank lending growth has slowed to 11% year over year in January compared to 20% year over year during the same year ago period. While banks are unlikely to increase lending immediately, the fact that they have more capital available implies that lending should pick up pace in the coming months, which should further stimulate growth. Bottom line, it was a week to forget for the Indian markets. And to be honest, the start of March is unlikely to be great either, given that President Trump, like I said before, has indeed confirmed tariffs on Mexico and Canada starting today, an additional 10% on China. Don't also forget that reciprocal tariffs could also be coming, and India being a key, India could be a key, victim to that particular reciprocal tariff whenever he chooses to deploy them. The US markets crashed on Monday upon slowing economic data and the confirmation of tariffs. There's no doubt that this would have a negative spillover effect on the Indian markets in the coming week, one that's likely to persist in the short term. However, as far as I'm concerned, I repeat the same message I told you last week. This is not the time to give up on the Indian markets. The panics and panic sell if you're a long-term investor. It's not a trading show, it's an investing show. Trading show, traders, you don't need to take any of this suggestion or anything. You guys got to do what you guys got to do. That's fine. I'm speaking completely from a long-term perspective. On the contrary, as if you're a long-term investor, it's a wonderful opportunity to assess your portfolios and to see whether there are gems in your portfolio that have become collateral damage. If the answer is yes, then the time to load up is the next few weeks. Because as confirmed by the latest GDP data, the Indian economy is in no way, shape, or form broken. And at some point, the foreign institutional investors will realize it. And will stop their selling spree that we're witnessing right now. The problem is, once they do that and you haven't done anything, you might be too late to the party again. And you have no choice but to live in regret, thinking what could have been. Stock markets have no place for emotion, guys, no matter when they are going up, and especially when they're going down. On that note, let's head to the final segment, Dr. Dissects. In the Dr. Dissect segment, we're going to move from technology. Yeah, we're going to move from the tech companies. We've been talking a lot about tech companies. We're going to move away from tech companies. And now we're going to bring in a very unusual player into the segment, coffee giant Starbucks, ticker SBUX. As a company who has a new CEO, I've decided to put the company under the microscope. Clearly, I've decided to put the new CEO under the microscope and see what happens. Listen, Starbucks released its Q1 earnings towards the end of January, and it was a decent start to the fiscal year for the company. Both the top and bottom lines estimates, despite the growth, both the top and bottom line estimates, despite the growth of both metrics being down on a year-over-year basis, the company beat both the top and bottom line estimates. More specifically, Q1 revenues of $9.4 billion beat estimates by 90.9 million, but were down 0.3% year over year. Non-GAAP EPS of 69 cents marginally beat estimates by 2 cents, but were down 23% year over year. Comparable store sales, a very valuable key metric for companies like Starbucks, continued, unfortunately, their downward trend, both in North America and especially in the US, as well as in the company's international markets, with a 4% year-over-year drop in both segments. Weakness in China continued, with comparable store sales declining 6% year over year. Operating margins also continued their downward trend, down a further 390 basis points or 3.9%, coming in at 11.9%. However, the decline in operating margins for the quarter was very unsurprising in my opinion, given that the company is making massive investments as it attempts a turnaround. While the company has suspended its guidance, citing this very own turnaround strategy, management did offer some insights into what is to be expected in the coming quarters. For instance, during the earnings call, CFO Rachel Ruggeri mentioned that the EPS would be the lowest. EPS would be the lowest in Q2 on an absolute basis, attributing this to both seasonality and the elevated investments as part of the Back to Starbucks strategy. Management forecasts EPS to subsequently improve in the second half of FY25, both on a sequential and on a year-over-year basis. The overall general and administrative expenses as a percentage of revenue is expected to be higher year over year. Coffee prices are also expected to be a headwind on EPS, along with the channel development segment on account of volatility in seed prices. So overall, if you look at it, it was considered to be one of those kitchen sink quarters where it was just bad, and then ugly. And given the fact there's no rapid guidance as well, is a big problem. Now, here's why I'm still not panicking for Starbucks investor. In fact, I'm not even too much negative on the company, despite all these negative numbers being thrown in my face. The main takeaway, and this is because the main takeaway from Starbucks Q1 earnings report, in my opinion, is that the company so far seems to have made the right choice to hire Brian Niccol as the CEO. He was the superstar at Chipotle. Turns out he's already making the right moves that could very well make him superstar CEO at Starbucks. Despite all the key metrics such as comparable sales and operating margins continuing their downward trend, there are signs that the new CEO's Back to Starbucks strategy is already having a positive impact. This is evidenced by the uptick in consumer sentiment surrounding the company, as evidenced by the growth both on a sequential and on a year-over-year basis, seen in the number of 90-day active members of the company's loyalty program, the Starbucks Rewards, which reached 34.6 million. The company's move to reduce the frequency of discount-driven offers saw the number of discounted transactions declining 40% year over year, which is great for margins. And it actually also led to improved ticket growth in the United States, which reduced the magnitude of decline in the overall comparable sales in North America compared to previous quarter. The reduction in discounted transactions enabled the company to make more consumer-centric moves, such as removing extra charges for non-dairy milk consumption. Now, in addition to all these charges that I've mentioned, Starbucks management also made some moves to address yet another issue that was plaguing Starbucks customers, which is congestion around the counter areas. The company is currently piloting a program that introduces a sequencing system in the company's mobile ordering system. The results so far have been very positive, and in stores where the bottleneck situation were mitigated, management announced that comparable sales were showing positive sales growth, which suggests that the strategy is paying off, albeit the impact is very small given the fact that they've just started. However, despite all these positives that you're witnessing in the US markets, across various stores and Starbucks, all of that, the company continues to be a show me story to me. Okay, CEO Niccol is only 1 quarter in, and while he has set the ground running immediately, the overall financial performance, as I mentioned earlier, continues to trend downward. Moreover, based on management commentary, investors should not hope for this trend to reverse in the near term. CEO Rachel Ruggeri, as I mentioned in this, CFO Rachel Ruggeri, as I mentioned in the past, as I mentioned a little bit earlier, has said that Q2 EPS would be the lowest on account of restructuring charges and an increase in investments, both of which can be attributed to the back to Starbucks strategy. Now, in addition to excess in investment required for the turnaround strategy, there are external headwinds to consider as well. For instance, Arabica coffee has been up more than, prices have been up more than 40% in the last 3 months and is up 79% in the last year. The recent spat between US and Colombia has also been a tailwind for coffee prices, and given that Colombia accounts for a significant portion of the company's coffee imports, Starbucks' coffee imports, investors should keep an eye out for how the geopolitical tensions play out between the two nations. Then there's, of course, the China overhang, where the company has had a very tough time reversing the decline in sales. Moreover, the company is consistently losing market share to rivals consistently. The quarter gone by was no better, with comparable sales declining 6% year over year. And unlike in the company's North American markets, the average ticket growth actually declined in China and was a major contributor to the overall sales decline. This is on account of a coffee price war in the region, and given that Starbucks has been losing market share consistently to its rivals, the fact that the company had to resort to discounts is no surprise. It is also no surprise that the company is exploring options for its China business, which could actually include selling a stake in the business or teaming up with a local partner. Given the turnaround strategy requires major investments, these options are appealing in my opinion and would be the right thing to do from a long-term perspective. Overall, it has been a good start to the Brian Niccol era. The initial moves made by the company are slowly but steadily bringing consumers back to the cafes, and there is evidence that loyalty to the brands is showing signs of revival. Having said that, 1 quarter is not a significant period to draw conclusions, and as such, Starbucks continues to be a show me story. I have got my book out, notepad out, pen out. That can only mean one thing. We're going to do some valuation. Yeah. We are going to do some valuation. So what company are we discussing? It's Starbucks. Now, Starbucks is a very interesting one to deal with because the guidance is simply not there. So according to LSEG data, Starbucks currently trades at a forward price to earnings of 30.5x. 30.5x, which makes it more expensive relative to its historical levels, given that the 5-year historical median forward PE stands at 27.5 and the 10-year historical median stands at 26.5. This is not surprising in my opinion, since the stock has been riding the positive news, driven by both the hiring of Brian Niccol as well as the plans he has laid out in the Back to Starbucks strategy. Moreover, in his first full quarter as CEO, his plans are already having a positive impact. However, there is much more work to be done, a fact acknowledged by the management during the earnings call, and as such, I don't think the stock should be trading at such a high multiple. This is further confirmed by the Seeking Alpha's valuation scale, which rates Starbucks as, get this, F. Okay, Starbucks valuation in Seeking Alpha is F. So factoring in all the elements, I'm not going to do 30.5. I've assumed 27.5x, which is the Starbucks 5-year forward PE as my multiple for calculations. 30.5 is where it was trading. I've slashed it down to 27.5. It's a show me story. Okay, according to LSEG data, analysts expect Q2 EPS to come in at 53 cents. Q3 EPS to come in at 89 cents. And Q4 EPS to come in at 80.87 cents, 87 cents. So 53 in Q2, 89 in Q3, 87 in Q4. Now, this estimates follow the trend projected by the management, which was that EPS is expected to be lowest in the second quarter before picking up in the second half of the year. However, management did say that on a year-over-year basis, EPS growth for Q3 and Q4 should be positive, which is not what the analyst estimates are currently projecting for Q3. They are expecting a positive year-over-year growth for Q4, but not in Q3. Now, I'm siding with the management, especially after seeing the positive effect the management's moves have had on the company's consumers. However, I've assumed a conservative 1% year-over-year growth in Q3 EPS, which would be 94 cents, yeah, which would take it to 94 cents. So Q3 EPS is 94 cents. Taken together, so 53 cents in Q2, 94 in Q3, 87 in Q4, and you have got FY25 EPS coming in at $3.03, which would imply a decline of 8.45%. Clearly, the trend is expected to be downward. So 3.03, the FY25 EPS. A reasonable estimate given the magnitude of investments required for the turnaround strategy. So I do expect a year-over-year decline in EPS. However, Q3, I do expect a 1% year-over-year growth. Now, according to Seeking Alpha, the company's forward price to earnings ratio stands at 3.83, significantly higher than its own 5-year ratio of 2.56. Now, if you take 27.5, okay, if you take this forward P of 27.5 and a PEG ratio of 3.83, this would imply earnings growth of 7.2%, a much more reasonable estimate, in my opinion, compared to 10.7%, which is the result of assuming a forward PEG ratio of 2.56. So what I have done is I've assumed a PEG ratio of 3.383, forward PE of 27.5, and that would put EPS growth, projected EPS growth at 7.2%. So projected EPS growth at 7.2%, 3.83 PEG, 27.5 forward PE, which would lead to FY26 of $3.25. Yeah, FY26 of $3.27, $3.27, and the price to earnings is 27.5. So you take 27.5, multiply that by 3.25, and you get a price target of 90. Okay, price target of 90. That's the price target on Starbucks from my perspective. This would imply the stock is currently overvalued by a whopping 22.5%. Now, despite the significant overvaluation, I would not recommend a sell rating on the stock or a short rating on the stock because the stock has something called relatively strong momentum. It has an A- grade on the Seeking Alpha momentum scale, and that's a jump from B+ about a few weeks back. So from B+, you have A- in the momentum. It just shows to show the momentum continues to be strong. Moreover, the back to Starbucks strategy does show signs of paying off. I wouldn't add to an existing position, however, and neither would I initiate a position at these levels. So I'm not going to add into more position, I'm not going to start a new position. So I'm going to put the rating on Starbucks as a hold. So 90 hold rating, and it's a $90 price target. Bottom line, Starbucks had a decent start to the year, with both the top and bottom lines beating analyst estimates. While all the key metrics continued their downward trend, the growth seen in the membership numbers does suggest that the company's turnaround strategy is already having a positive impact. Management under the leadership of Brian Niccol has proactively taken steps to ensure that the issues that were driving customers away, such as congestion at counters, are being mitigated. However, it's too early to rate the turnaround strategy, given that Q1 was the first full quarter under Mr. Niccol's leadership. Furthermore, the company continues to make significant investments, which should be a near-term headwind on the bottom line. Rising coffee prices are also not going to help. And then there is the China overhang. In my opinion, the company has no choice but to partner with a local rival to revive the business in the region. After the earnings release, the stock jumped more than 8%, and it has continued to jump even more, continue to gain even more since then, which is understandable to an extent, given the immediate impact that Niccol and his team have made. However, from a long-term perspective, there is a long way to go, in my opinion, before one can call the turnaround story a success. As such, Starbucks continues to be a show-me story, and investors are better off waiting for the clarity before jumping into the name. That's all the time I have for you this week. I really hope another Tuesday episode fits in well with your schedules. I will obviously keep track of it, and if it's not working out, I go back to Sunday again. If you have a specific Indian or US stock suggestion for the Doctor Diagnose and Dissect, do tweet me at Uttamvinay, UTHAMVNAY, or email me on the Stock Doctor Podcast at gmail.com. Thank you once again for listening. See you next week. Until then, stay safe and make some money.